What a track. Okay, welcome guys. Risk management is what it is all about. Without it, it's straight up gambling, right? If you can apply this risk management profile that I'm going to be teaching you, it is impossible to blow an account. And if you follow this process, more powerful than any strategy, more powerful than anything else, it will maintain that you make money. And when you make money big. And when you lose money small. And it becomes virtually impossible to blow an account. You could literally flip a coin. As long as you've got risk management and risk to reward down to a T, it becomes impossible to blow an account. And you can take that to the bank. I know it sounds absolutely crazy, but it is the truth. And I'm going to show you that. We're going to go through some experiments together, but ultimately I really want you to spend time on this video. Make sure you have no distractions around you. Take a notepad, take a pen, and this is what you really want to focus on. This is what trading comes down to. Everybody is strategy crazy and chasing the newest thing, but the thing that I see most traders lack is risk management. I have very little regard or respect for someone who's able to make $1,000 off a $100 account and they risked it all. Ultimately, you find a week later they blow it all at the end of the day. I have a large amount of respect for someone who can take $100, consistently make $3, $4, $5, $10 a day with risk management and grow their account and grow their profile to the point where their account is now large and that they've built that through time and through risk management. That is the right way to go. That is investing in moving closer towards a professional way of managing money. Anybody who is involved in managing institutional money will tell you risk management. Everything is about mitigating risk and having as little risk as humanly possible. If you follow this process with me, I can guarantee you it becomes impossible to blow an account following this process and these steps. So spend some time on it, remove any distractions around you, pen and paper. This is what it is all about. So let's jump right into it without any further ado. Beautiful. Okay, so let's get into it. Let's have a look at what this whole risk management thing that Dane is busy talking about. Let's have a look and let's see. Okay, risk management without a doubt, one of the most important factors in Forex and in trading in general. Our aim in being traders is to be profitable and be consistent, right? Everybody wants to make money, but we want to make money in a consistent fashion. If you can get to the point where you're not only profitable, but you're consistent, you can start to map out and say, okay, I'm making X amount within a week, X amount in a fortnight, X amount in a month. And you can start to get to the point where you can gauge, can you even make this a full-time career? But you cannot look at doing that if you're making $1,000 one week and losing $2,000 the next, making $5,000 the next, losing everything there and after. You need that consistency. You need to build that track record. And the only way you can do that is by safeguarding your downside. Everybody wants to protect their downside. That is what it is all about. I've had many interviews with traders who want to work for me and want to become, full-time professional traders. They want to trade institutional money. The first thing I ask them for is show me your record, show me your trading history, show me what it's all about. And they've got these beautiful gains. They've got these, 30, 40% gains day on day, 100% gains, 200% gains. But then when they lose 60%. And I look at this and I'm like, who in their right mind would ever let you manage money? If you're making gains, that's great, but people care about protecting their downside. I don't want to see more than 2 to 3% in terms of total risk on a whole book, on a whole account. And then never mind that, you see these guys lose double digits, 30, 40, 50% in a single go. So risk management is absolutely key. It's key for you to gauge your future. It's key to make a career and a full-time living and income out of trading the Forex and financial markets. So in order to be profitable, obviously, we need to just consistently make more money than what it is we lose. Currencies trade against each other are traded in bundled groups, and these are called lots or volume, right? So when we trade currency, we don't trade 1 rand of ZAR or 10 rand of the dollar or 100 points of gold. We trade them in these bundled groups called lots or volume. Now, for the purpose of currency, these lots are standardized into what we call standard lots. Right now, a standard lot is a lot size of 100,000 currency units. So if we buy a standard lot 1.0 of, let's say, USD ZAR, it means we're buying 100,000 units of dollar currency, right, in that particular measurement. So lot size determines how much we stand to make or lose with every tick or pip that the market moves with us or against us. So as an example, let's start with a micro lot. Let's say we enter Euro USD or we enter USD ZAR, whatever the case may be. We enter, let's say, Euro USD, and we buy and enter a 0.01 lot size trade, right? Remember, volume is one of the very first things you have to enter when it comes to executing a trade, if you guys remember from the different orders, immediate and pending. So if we enter a 0.01, right, immediately we will then pay spread. If you guys remember from that last one we looked at, the spread was around about 1.9 pips. Now we can then work out how much it is we're paying towards that spread. So we can look here at 0.01. It means that we are entering 1,000 units of currency. We're placing an order for 1,000 units of currency, and for every pip the market moves, we stand to make or lose 10 cents United States. So if the spread on that particular trade we're looking at, Euro USD, is 1.9 pips, it means that trade will cost us 19 cents to enter, right, at 0.01. Then thereon after, every pip the market moves, if the markets move 10 pips up, right, in our favor, let's say we're buying and it moves 10 pips up, it means we would make 10 times 10 cents, which is a dollar. If the market moves 100 pips, we'd make $10. If it moves 1,000 pips, we would make $100 in profit. Equal and oppositely, if we entered a buy trade and the market moves against us, we would then, if it moves against us in, let's say, 30 pips, we would lose $3. Okay, and so this is the most important thing we need to understand, because it forms the base of how we enter a trade. The volume that we enter in determines how big our stop loss will be, but our stop loss also needs to be determined by previous market structures, so that if we see, as an example, we want to enter Euro USD as a buy, okay, and the next level of support below us is 100 pips below us, okay, but we want to enter a one lot trade, but we only have $1,000 account. One lot, right, means that every pip the market moves with us or against us, it results in a $10 profit or loss. If our stop loss is 100 pips down at a standard lot, that means it's $1,000. Our account is wiped out. So it would mean we would need to fall closer to a 0.01, which means 100 pips will equal $10. $10 in relation to $1,000 means we're risking 1%. So we can start looking at a 0.02, which will mean we're risking $20, and so on and so forth. So we want to get closer and closer to that 2 to 3% on all trades linked to that particular instrument. So if we're trading Euro USD and we're entering 3 positions, our 3 positions total need to equal 2 to 3%, and that's our stop loss, not what we stand to make. Okay, now this is one part that many people mess up, and their risk management is just, it's unfortunate, right? There are many positions that we can take out there that give us massive reward. And so it is far better to have a small stop loss but aim for longer trades than it is to take the super short trade, massive risk, massive lot size, and if it doesn't go away, it wipes out 10, 20, 30%, sometimes a whole account if a person is not serious. So the lot size determines how big of a trade you can take, but also at the same time, each trade that you take will also have a minimum margin. So if you have $100 as an example, you won't be able to enter a one lot trade, for the reason being that you're buying 100,000 units of currency, and the margin requirement will be something like $100 in order to just take that trade. So you'll notice there's various things on your trading platform. You'll have balance, you'll have margin, and you'll have equity. All of these things play a valuable role in terms of what size you can take. But honestly speaking, if you're always targeting 2 to 3% of your account, you never even have to worry about those things. You never have to worry about hitting a margin call, any of those things. So I'd prefer to teach you how to manage the risk, and then you don't have to manage your margin, because if you ever get to the point where you have to manage margin, your risk undoubtedly is through the roof and way too high. So the most important thing is to start to understand lot sizes. Now these are customizable. You can enter up to 100 lots on some instruments, and you can go as low as 0.01 on a standard account, where that's what's called a micro lot. You can go 0.02, you can go 0.33, you can go 1.33. So the lot size is completely customizable based on your account and based on your risk and reward profile. Now risk and reward is obviously equally as important, but let's quickly go through the next bit of valuable information, which is something that you absolutely need to know when it comes to how to place this trade and how to position yourself in a market. And this is called position sizing, right? To make sure you don't overextend your account, and that ultimately you can take multiple trades. And if you're always making sure you have a risk reward ratio greater than 1 to 3, again, it becomes impossible to blow your accounts. And again, you can literally flip a dice, if you know, or flip a coin. If it lands on heads, buy, and if it lands on tails, sell. And as long as you have 2 to 3% risk and around about 6 to 9% reward, you'll always be in a position where you're making more than what you're losing, even if you straightforward want to flip a coin. Now, when you can apply that to a strategy, this becomes immensely powerful. And this is how people are able to build a life or a career out of trading, and it's all about managing the downside. Everybody's looking at the reward, everyone's looking at how much can they make. When you start to take this very seriously, you're worrying more about the losses, you're worrying more about the negatives. Set that in stone, keep it a absolute science, and then you don't have to worry. You can never blow account. So based on the previous table, if we take a position with the market of 0.01, every time the market moves 1 pip in our favor, we make 10 cents. So if the market moves 30 pips in our favor, we close our position, we've made $3 minus the spread, as we said on Euro USD. At that point in time, it was round about 19 cents. So we would end up with a position here of round about $2.81 for that particular trade. Now, as a rule of thumb, guys, do not exceed more than 2 to 3% of your account size per trade. Now, if you've got a round account like $100 or $1,000, it becomes very easy. On $100, you don't ever want to risk more than $2 to $3 on any one trade. If you've got a $1,000 account, you don't want to risk anything more than $20 to $30 on any particular trade. Now, when I say trade, I mean all trades associated with that position. So if it's Euro USD and you want to enter 3 positions, each position should be about 1%, not each position 2 to 3%, because 3 trades at 3% go wrong and you've lost almost 1/10 of your account in one go. And that obviously will not mean you're going to make it to the big leagues. It just means you're going to be gambling more often and causing yourself excessive stress that you don't need to have. So in the above example, if our account was $100, we would have made 3% of our account, which means we've risked 3% of our total account if the opposite was true and our stop loss was also sitting at around about 3%, which is 30 pips. Okay, so the larger the account, the higher lot size you can use in relation to that account, in relation to that account size. But remember, it's all got to do with where your stop loss is. Now, your stop loss is not something that you should dictate. The market should dictate where it would be safe. You need to have a look at, okay, I'm looking at this particular trade, and the next level of support below me is 30 pips away. The second level of support below me is 60 pips away. That is a safe zone. So I need to have a 60 pip stop loss. How big of a trade can I potentially enter? Now, if you've got a $100 account, 0.01 at 60 pips will put you at about $6, right? That is 6% of your account. You cannot afford to take that trade, which will mean you need to wait for a safer position, or a position that allows you to have a smaller stop loss. That is just unfortunately the reality. Or you got to look for something that isn't as volatile, and it's got a slower or smaller pip count that you can potentially look at taking advantage of. Now, this is where 95% of traders go wrong. Every time I look at traders' journals, every time I have somebody come to me or ask for consultation, this is my trading history, I've got capital, I've got everything, I've got all these things, but this is where I'm going wrong. This is the one place that I see traders go wrong. I've seen traders make a ton of money. I've seen amazing things, but I've also seen traders lose a ton of money, and this is purely down to risk, right? Now, most people will never teach you how to manage risk effectively, because again, they want you to trade high volumes. They want you to enter 50 lots, 1 lot, 5 lots, 100 lots, because this means bigger volumes for the broker, means a higher chance of you end up losing your money, and everybody else gets paid besides you. You want to be in this for the long run. You don't want to be in this for 2-3 months. You have a good month and a bad 2-3 months there and after. You want to be in here for the long run, right? You've always got to ask yourself when entering a trade, if this trade goes against me, what am I willing to lose on this particular trade? Now, if you ask yourself that question, right, and you ask yourself that question about all trades that you're running, and you even hesitant about the answer, you clearly have made a mistake. So when I enter a trade, I look at my risk. I'm risking 2 to 3% of my accounts. If it goes against me, am I okay with how much I may lose in this trade? Sure, 100%. No problem. That is the answer you want to have. And ultimately, when it comes to trading, guys, you never want to put money in the markets that you are not willing to lose, right? This is something that changed my life when it came to trading. I was always taking, large amounts of money from here and from there, putting it in and trading with this absolute stress of you've got to pay this money back, or this came from that, or you took that out of this, or you sacrificed buying that for this. Ultimately, you don't ever want to put money into the markets that you are not willing to lose, because the psychological bond with that money, we're going to talk about the psychology a little bit later, is very, very strong, and you're going to make crazy mistakes. You're going to risk more than you should, and ultimately that's going to end up with you looking down the other side of a trade, and not the good side, the arse end, the bad end of a particular trade. So here's a basic formula that you can use. And again, leverage also has a play on this, because leverage will determine the type of margin your account can obviously handle for every type of trade that you position. But ultimately, and generally speaking, if you follow a risk management protocol, you'll never have to worry about margin, as I've said a little bit earlier. You're welcome to stop, pause, let me remove my face for a second, and you're able to just take a screenshot, capture this if you will, and you can use this as a rule of thumb when we talk about the different types of accounts. Now, we see a lot of people open $100 accounts. $100 account is fine. It's a little bit small, but it's a good place to start. There's nothing wrong with that. I encourage people to start with as little as possible. It is harder, but ultimately it's going to teach you, you cannot afford to even budge on $100, right? You cannot afford to take all the trades in the world. You're going to see us trading some crazy things. You want to jump in, but you cannot because you're already overexposed on other trades. So $100 is going to really teach you discipline. It's going to be frustrating, but it's perfectly fine. It's the right way to get started. It's the right way to learn. So if you have a $100 account at 0.01, 30 pips will represent 3% of your account, which represents $3, either profit or loss. At 0.06, 30 pips represents 18% of your account, and 0.09 at 30 pips represents 27% of your account. So you can imagine with $100, if you open a 0.10, the markets literally just need to sneeze. 30 pips is nothing, guys. Markets just needs to sneeze, bump down 30 pips, and your $100 is gone. Your account is blown. So you need to start small. You need to start humble in order to build that account size to get to the level that you need to be. Now, just as an example here, if you opened a one lot position, which you can't on a $100 account, your margin won't allow you. But if you opened a one lot position, not only are you going to immediately pay $19 in terms of spread, but if the markets then moved 8 pips, your account's blown. Okay, your account is completely blown. 8 pips is nothing. Markets like VIX and these kind of things, they move 800 pips in a day quickly. No issues, no stress, right? So this is just obviously to point out the importance that if you obviously want to trade long term, this is unfortunately what it takes. It takes that commitment. It takes, being okay with, managing your risk and managing your trades. Now, as I've said, risk management and how big that risk is to your account is all determined by where you place your stop loss. You can pick any lot size you want. Ultimately, it is determined by your stop loss. The closer your stop loss is to your entry, the bigger of a lot you can take. But again, your stop loss is not determined by you. And this is why a lot of traders don't even use a stop loss, because they can't get the math and the science right in terms of where to place a stop loss in a safe place. Now, this is something I encourage because it's going to cause a little bit of pain in the early days. You're going to do this beautiful analysis. Your USD must spike up. You've got this whole plan in your head. You set up your trade. Everything's on point. Your stop loss is just here. Markets come in, kiss your stop loss, takes you out the trade, and then markets shoot in the direction that you'd originally analyzed. And that is a painful feeling. It's bittersweet. It's bitter in the sense you've been taken out of a trade that you should have benefited from, but it's sweet in the sense that your trade analysis was right. The issue here is the placement of your stop loss. Now, in the early days, this is going to happen. I'm telling you up front, this is going to happen. And if you're a trader that's got a bit of experience and you've given up on stop losses, I want to ask you to give it another try, because this is the one thing that absolutely safeguards your account. You cannot trade long term without a stop loss. It is not possible, right? Unless you have this unique ability to identify risk and you risk your whole account and you've got 10 different accounts. Those accounts then are your different stop losses, right? There's a lot of traders that open 10 different accounts. They risk each account to its full value. You're risking 10% of your portfolio. The only difference is you're segmenting them into 10 different accounts. One account is 10% of your portfolio. So you're still using a stop loss. It's just you're making your life so difficult. You got to log into all these different accounts. Be smart, right? Work smart, not hard. All right. So as we've said, this is all determined by your stop loss and where your stop loss is in relation to your actual trading setup. Okay, so let's have a look at this and what does this mean. So now that we understand lot sizes in relation to pips and account size, we can place a stop loss on our trades so that if the market moves against us, we limit our exposure to around 2 to 3% that we are willing to lose. Before you place an order, you need to calculate on average around about 30 pips from the current market price. Now, we say 30 pips, and on some of your major setups, on your major currency pairs, 30 pips is around about that sweet spot. It has increased slightly with the different volatilities we're seeing in the markets recently over the past couple months and year, and it's probably closer to about 45 pips is that sweet spot that we're finding that consistency. But in all honesty, this is something you need to gauge on a case-by-case basis. Market structure will show you and determine where it would be safe to place your stop loss, and I will go through this in great detail when I'm going through the strategy, because as I'm going through the strategy, I'm physically going to pick a random chart, we're going to map it out together, all the different steps together. I'm going to place a trade, put in my stop loss, do the calculations, do some pending orders. We're going to do a full setup. So you're going to see how we do that. But again, ultimately what I'm saying is that the stop loss is determined by the market, not by you, right? You need to follow what the markets are giving you from a structural point of view. Because if you just place your stop loss anywhere, like I said, market's going to come down, kiss that stop loss, take you out that trade, and you're going to be left the next day feeling used and abused. All right, nobody wants to have that feeling. It's not great. So before you place your order, you need to do the calculations and place your stop loss in relation to your particular trade. So if you're buying, your trade stop loss needs to be below. If you're selling, your stop loss needs to be above. So in the position where we're selling, we look at our entry price and we add 30 pips to calculate, right? So that the stop loss is above our price. In the case where we're buying, we would look at our entry price and deduct 30 pips. So we find out what price is our entry minus 30, and that's where we would place our stop loss. And again, we will do the math together when we're going through the strategy. But it is super important that we make sure that happens. So example, here's a GBP USD trade that we would like to enter in. And we can see that the market price that we're getting here is 1.3101, okay? And 2. So we need to minus 30 pips off of that price, and that is where we end up getting to the 1.30719 as our actual entry price of where we need to enter. So that's a 30 pip deduction, and that means that when the system gets to that level, right, which is below, so this is obviously a buy entry because the stop loss is below, it will then close that order for a predetermined amount. Now in this case, if we're entering 0.03, and this is a bonus question, so listen up, if we entering at 0.03, okay, and we place a 30 pip stop loss below our entry point, if markets move down and hit our stop loss, what will be the negative or the amount that we stand to lose? And I'd like for you to pause this video and answer this question. So 0.03 means that for every pip the market moves, that's 30 cents US. So do the math, 30 cents times 30 pips. I would love to know the answer from you, and you can go ahead and pause and resume directly afterwards, and we can see if you got it right. Okay, so if you answered $9, you'd be 100% correct. Now, obviously, you need more than $100 account in order to be able to risk $9. You would need about a $300 account for $9 still to be part of your risk management. $9 at $300 would mean you're still risking that 3% and you are effectively safe. So this is super important for you to practice and obviously to go through, but I'm also going to show you a really cool technique that I use if I'm looking at a market and I want to calculate the pips and the stop loss. We can also go ahead and put a pending order in place that will help to calculate the different positions that we have involved. So we put in a pending order at 0.01 as a buy limit. We put a random stop loss and a random take profit, and then we drag them to see what the resulting profit or loss is going to be. And that's just a really great technique, specifically if you're starting out and the math is overwhelming and the volume is overwhelming and the take profit's overwhelming. I'm going to show you a really cool way of just simplifying that whole process for you. So let's quickly have a look at what we're moving on to next, and then I can see at what point I can jump in and we can obviously look at that process from a simplification. Okay, so up next we're going to be discussing the take profit. So I want to go through the take profit, and then I'm going to show you on your trading platform, if this is a lot of information and you just want an easier way of getting to that number, the most important thing is getting to a number that you understand before the trade even starts. That is what I'm willing to lose or risk on a particular trade. That is the most important thing. If you can have that in your trading journey, you are on your way. It's now just about perfecting your arts, your craft, perfecting your methodology, and ultimately taking in all the other processes and just now cementing, because you've got the risk management down. You're going to perfect the psychology. I'm telling you, if you can nail this down out the get-go, you are on your way to the victory line, right? Now, as part of the final due diligence when it comes to risk management, we obviously need to make sure that we are set to some sort of profit goal, right? You don't see people start a car in the driveway without knowing where they're driving to or where the destination is, right? In the same way, you should not enter a trade without knowing, or at least having a goal of where this trade should get to before you'll be in a position where you're satisfied and you will close that particular trade. So we want to at least make sure that when we're trading, we're not making equal amounts to what we stand to lose, right? So if you're risking 30 pips, there's no ways in earth you want to risk 30 pips to only make 30 pips. It's not worth your time. Your money is safer in your pocket than it is on a one-to-one risk reward trade. So we talk about risk reward. If your risk is 30 pips, right, and your reward is 30 pips, they equal, they one-to-one. You want to be in a position, absolute bare minimum, where your risk reward is 1-2. My bare minimum is 1-3. So if I'm risking 30 pips, I don't want to risk 30 pips for anything less than 90, right? That is a 1-3 risk reward. 1-5, 1-6, 1-10. Now that is where the money is, and that's where you want to be. So a trade is not just about you think the market's going to go up, but at what point and to where do you think the markets are going to be? Because if you've got this little range that's running in a market, so you've got this little channel that you want to trade, and you've got a 30 pip stop loss, but the top of the channel is also only 30 pips, guys, the money is safer in your pocket, and better you don't trade that trade. It's not worth your time, because even if you win half your trades and lose half your trades, you're going to be in the same position as when you started. All you're going to do is gather and gain a little bit more experience, which is great. But you're here to profit. You're here to build consistency. That is what it is all about. So we want to make sure our risk reward is higher than 1-2, minimum 1-3, and that is going to ensure that we're at least making more than we're losing. When we lose small. When you win big, right? Now, when your trade reaches this predetermined area, this take profit area, the trade will automatically close. The same way it will close automatically if it hits the stop loss. So as it hits that area, as the name suggests, it will take your profit and close your trade and put that trade, the balance directly into your account. So if we placed our risk at 3%, which is $3, 3 pips at 0.01, it means we need a take profit objective at least of 60 pips, ideally closer to 90 pips, to at least give us a 1-2, ultimately 1-3 risk reward, right? People talk about profit loss objective, P&L objective. So your profit needs to be more than your loss. I prefer to talk about risk reward, right? So if my risk is 30, my reward needs to be 90. That's a 1-3 risk reward, just to clarify that for all of you that are out there. That is the most important thing. So again, as we're entering that trade setup, you can see over here for the stop loss, we deducted our 30 pips, right? So it means our stop loss is currently set at 30 pips below the current market price. We would add here our 60 pips to the current market price to give us this result of 1.31236. So it means that when markets reach that particular level, we will then obviously have that additional TP in place, and we then obviously benefit from that particular trade. So you would add that to the current market position to make sure that your TP is in the right place. Now, the great thing about pending orders is that when you set them up, you can visually see it to make sure that is correct. Now, once you've placed the trade, you can always edit and alter some of these levels by just dragging, and I'll show you how that looks. But right now, I want to show you a very cool technique that you can use in order to gauge a particular market when it comes to this particular subject. Now, I want to spend time on this because I see this is something that so many people get wrong, and I want to make sure that you guys absolutely smash it. I want to see you guys out the gate. Like I said, I have so much respect for someone who has a $100 account, who is practicing risk management and growing by $2-3 a day. Man, I have so much respect for that. If you got a $100 account and you show me you made $200 in a day and zero risk reward, I couldn't care less. I know hobos on the street that are able to do a better job than that. Risk management is everything, right? That is what it is all about. So for this next part, I want to show you guys something pretty cool. So what I'm going to end up doing here is I'm going to open up my trading platform, right? And I'm going to show you how I would use a pending order to essentially set up my trade as if I'm setting up a brand new trade. So let's look at this together. And again, I'm spending a little bit more time on this because it is so important. So let's jump into it. I've got my trading platform open over here, and let's pick a brand new setup. Let's pick up, let's say, gold, right? So I'm going to open up gold. I'm going to go into my templates, and I'm just going to go and load up a little bit of a naked charts right there. Okay. So I'm going to do some quick analysis here, and I'm just going to do just a basic analysis in terms of what I'm seeing. And then we can go ahead and we can jump in and we can simulate a trade setup based on this market formation, based on what it is that we're busy seeing. Okay. All right. We do have a level, quite a key level of resistance there. Okay, beautiful. All right, so let's have a look. Let's break it down. I just want to get a little bit closer. So I could just simulate any trade setup, but I want to simulate something closer to reality. Okay, so let's say, for instance, in this very particular case, right, that we're looking at a buy position on gold. So what I want to do here is I just want to edit this line just to make it a little bit thicker, a little bit more observable. There we go. Okay, so let's just say there is this market structure in place, and I haven't gone through the full analysis. I want to show you a technique when it comes to risk management of just getting this process nailed down, and just something that works really great every time, right? What I want to do here is I want to say, okay, I'm looking to buy, okay, and let's say for this example, I've got a $1,000 account. Let's say I'm using a $1,000 account on gold right now, okay, and I'm looking to buy this particular setup, and I'm looking for a buy because the trend is my friend. I've broken above resistance. I'm coming back. I'm leaning on support here, and let's say I believe vastly that the markets are gonna, turn around from this particular point, and we're going to get a nice buy objective. I can quickly come in here and just support that objective with that tool over there. And I'm going to be talking about this in great detail in terms of Fibonacci, but for the time being, just bear with me for a second. So I'm looking at a buy position, and I know that I'm immediately on a level of support, but we can see markets have pushed a little bit further down than that. And we can see that the next level below me is sitting at around about the next Fibonacci level, this 88.2, which is slightly down there below. That's the 88.2. And then ultimately, that's the second level of support below that. And that would be the 100% mark. And that is going to be a great place if we have a look at that market structure there, this is going to be a great place for me to position myself that if I'm wrong, I want to be out of that trade, right? If I'm down to the 88.2, it means that this market structure still has an opportunity to catch me and for price to continue up. So I'm looking for a buy opportunity, but I can also see that the next level supports 88.2, but I really want to be below this 100 level. What I'm going to do here, and don't do this too close to your actual trade because this can be bad, right? Is I'm looking at this trade and I want to place a pending order slightly below, and then what I'm going to do is I'm going to drag it up and I'm going to edit it. So market execution, I'm going to select pending order, and when it comes to the volume, I'm going to enter, oh, you know what guys, it's Sunday evening and markets aren't open, so I'm worried that it will not execute, which I'm seeing here it won't, right? Because we won't be able to physically place this order. But let me just show you the technique in any event, and you can go ahead and follow along. I would then go and look at, it's about an hour and a half, 2 hours from opening. I would then go and look at where would it be safe for me to enter. So 1809 as an example, and I'll just leave it as 1809, and I'll put in any stop loss below that, right? So 1809, maybe just put in a stop loss of 1806, and I'll just put in a random take profit here. I mean, this can go all the way up to the roof here, so let's just do the 1833 as an example. Now, if I have to place for this particular order, right, what will end up happening is it'll place a pending order exactly where I've set it up, right, just below with a stop loss over there. Now I've entered this order at 0.01. Even though I've got $1,000 accounts, I can enter a bigger trade. What I want to do here is I want to place it and then measure where is my stop loss, right? How many pips will that be, so that I can determine, okay, my stop loss is 180 pips below my entry price. At 180 pips, I can afford then to enter a 0.03, a 0.05, whatever the case may be, because at 200 pips below that, at 0.01, that's going to be a $20 stop loss, which is 2% risk. So I could look at entering a 0.02. That'll put me up to 4% risk, which is slightly high. So then I would settle on saying, okay, a 0.01 is perfectly fine. And my take profit in this case is, let's say, sitting at 1,800, 2,000 pips, which will mean I've got a risk to reward ratio of 1 to 10. I'm risking 200 pips to make 2,000, and my stop loss is equal to 2 or 3% of my account. Now, obviously, if I place this right now, it's going to tell me markets are closed. But the great thing is, when you do this in a live market, it'll give you the opportunity to obviously edit that. So you can obviously edit that and you can play around with that. So as an example, I think let me use VIX for this example, because VIX is obviously running 24/7. So let's open up a blank chart. So we've got a blank chart over there, and let's see what VIX is up to. And again, I'm not doing a full analysis, as I will show you in the strategy, because that takes some time. You can't just randomly enter a trade and just decide, okay, that is what you're going to do. So we're doing some quick math, quick analysis here, and we're looking at VIX and what VIX is up to. And so what we can see on VIX is that VIX is broken through this trend line, right? We see VIX over most weekends has a little bit of a downwards trend when that happens. And what we can expect here is potentially some sort of retest at this level, and then we can see VIX fall down. So we would want to then look at a pending order, a sell at this point. And so what we're going to do here is we're going to initiate and set up a sell limit. Okay. So what we're going to do is we're going to select the order type. We're going to set a sell limit 0.01. Okay, we're going to put in this price because VIX is a little bit far away from our price, so we shouldn't have to worry. For MetaTrader, you can simply click the center of your mouse and it will just open up this cursor view for you. And we're going to look at here, let's just set it up at 344,800. Okay, and our TP will just set way down, at 339,500, 339,500. Okay, and our stop loss, we need to look at what are the next zones of support. Okay, so we can see here we obviously have the structural resistance level, and that's our immediate support, our secondary support, and we've got a few support levels here, but ultimately we want to be somewhere above these wicks that sit right there. Okay, the difficulty with VIX is it's got a very high spread, so you need to account for that spread when obviously setting up. So we're going to say, all right, from a stop loss perspective, we would love to have a stop loss of roundabouts 347,430. Now, bear in mind, guys, VIX is a massively volatile setup. So let's have a look at this. Now, the pending order setup, it hasn't been executed, right? We can see there's our entry price, right? A sell limit at 0.01. And what we can do now is we can click on and drag our stop loss. And our stop loss will tell us here at 0.01, right? Our stop loss is plus minus 350 South African Rand, okay? Which is probably about $28, $25, somewhere around about there. So we can work out then that this over here is about a 250 pip stop loss. Okay, our reward at this particular point in time is sitting at about 800 Rand, which is probably about $60. So our reward is about 600 pips from a reward perspective. So you can then take this and look at the size of your account, and if I've got $1,000 account or 15,000 Rand account, I can say, okay, you know, 2 to 3% of 15,000 Rand, we are looking at around about 10% would be 150. So, you know, we can potentially risk 1%, sorry, is 150. So we can potentially risk, you know, 350 is the max. So we can see here 350 Rand is 3% of our account. We are at a good place, but remember, we obviously have to account for the spread itself. But this is a really great way of obviously making sure that you can see that physical value. You can draw the slider and obviously see what that kind of value may be. Now my face was involved in the other TP, so there I'll move my TP and you can see there it shows the actual value that we stand to make or lose. In this particular case, this is our TP. Now, obviously, if VIX falls, it has the opportunity to go right down to the floor, and that would result in obviously a 2,500 Rand trade, and that's off a 0.01. So, you know, a 0.10 will make that a 25,000 Rand trade. A one lot position will make that a 250,000 Rand trade, but at the same time, it would also make our stop loss at one lot, it would make a 50,000 Rand stop loss. Okay, so here we have about a 1 to 5 risk reward, but this is a really great tool, right, that I often use. And remember to delete your pending order if you're just sizing up your trade, because remember, this would just be making sure that your math is correct and you haven't in some way or some shape messed up that math, because you want to make sure at the end of the day you're risking a predetermined amount. And this is something, guys, if you can practice and you can get right, oh my word, like you are off to the races in a very big way. You are so far ahead of the pack if your risk management is on point. So like I said, lot size is where you start. Just to get a ballpark figure, start at 0.01, measure that, set up a pending order at 0.01 with a TP and a stop loss, drag that TP stop loss, make sure your stop loss is at least covering the second or third, if you're selling, resistance above you, if you're buying, support below you, and then ultimately drag up your TP to the point where it equals at least 1 to 3 or more from a risk reward standpoint. If you do this, guys, it is impossible for you to blow an account. Now, the other side of risk management, please, is once that trade is executed, double check even before it gets executed. I've seen many times, even in my own trading, I'm trying to enter a 1.50 or, a half a lot, 0.50, and I accidentally enter 5.0 as an example, and you enter yourself in a 5 lot position, these things can happen. So check before, check afterwards. Risk management is absolutely key. Up next, we're going to be jumping into psychology, the investment mindset. I'm going to be conquering and destroying some of the fears that you may have already, some of the fears you're already battling with, or some of the fears you may have if you've never traded before. And I'm going to show you that just by steering the course and obviously dealing with some of these fears become totally irrelevant, and it's just a numbers game, and you can conquer that. Moving on after that, we're going to get into price action. I'm going to show you some crazy things. We're going to get into Fibonacci, and then ultimately after that, I'm going to take you through the quantum growth markets complete strategy. It is a ton of information, but I can tell you, if you repeat this process, you are on your way to the races. I'm super excited. Let me know what you've learned. If you've liked this video, if there's more information you may have or more information you may want, you're more than welcome. Drop a comment down below. I'll be replying to each and every single one of you. As always, if you like the content, smash the like button, subscribe. If you didn't, go play in traffic, because I really don't care. I love you all. I'll see you guys in the next one. Okay, welcome back. Things are about to get exciting. We're going to jump into the investment mindset and psychology, and then we're going to move into price action. You guys have been hearing price action, this price action, that. Where is the price action? We're about to jump into it in great detail. I'm super excited about this. I'm super passionate about the psychology behind trading and how powerful this can be when you learn to master risk management with mindset and psychology, and you apply that into your trading strategy. We're about to have an absolutely amazing time together. I really want you to sit back and relax and pay attention to this mindset psychology session, because ultimately we fight a battle in our minds when it comes to trading. A lot of trades are won or lost before the trade is even taken, due to the actual risk management thereof, as well as the psychology and how we handle the stress and the pressure, our environment, so on and so forth. So I'm hoping you're going to learn a ton. These are items that I've learned over the last couple years to work on every single day. I cannot say I've mastered it, but it's a constant growth process that we go through in order to obviously make sure we make 2 steps forward, 3 steps forward, and only 1 step back every once in a while. So without further ado, let's jump right into it. I know you guys are itching to get started in this, so let's just jump straight in. Okay, so we're going to start with the investment mindset, right? And this is super important. This is going to really determine what type of trader you are going to become. Now, there's a lot of different things we need to obviously discuss, and there's, the big differences between when you're starting out, you want to get that time in the markets. You want to, obviously trade smaller time frames, get the activity, and there's nothing wrong with that, but you obviously need to be cognizant of the fact that you need to move closer to investing in the market and outside of these smaller trades that end up just being these really small scalps that your risk reward isn't there. So just bear that in mind. I am fully aware that if you're new in the markets, you want to get active, you want to get making money, and I will cover that in the strategy, some really great tips of how you can utilize smaller time frames to make good amounts of money whilst you wait for these bigger investment trades to materialize and show themselves. But let's go through this in a little bit of detail. So when we talk about investing and we talk about gambling, both of these involve a certain level of decision and risk. The purpose of investing is we take calculated decisions and we have the patience to execute, right? So this I really want to drill home. So both of them have got decisions and risk involved. The investing part means we have a calculated decision. We have a calculated risk management, which is what we covered in the previous video. And we have the patience to execute. The patience to execute is something a lot of people really struggle with because they have limited time to be in the markets, and when they're in the markets, they want to trade. The important thing to know note is that you don't need to trade when you just want to trade. The markets need to present themselves an opportunity that makes it worth your time to trade. Okay. With investing, the ultimate goal is lowering the level of risk and ultimately having higher returns over extended, stable periods of time. Now, this obviously all comes down to patience, waiting for that perfect trade. And there never is just a perfect trade. It's all about making them available and waiting for them in order to obviously execute. Now, when we speak about investing in the context of Forex, we're referring to identifying long-term trades that we're able to take with the appropriate risk management in relation to the value of the account and this relative stop loss in that position to obviously relation to the account and obviously lot size. So this is all coming into the calculated risk. Now, mindset, it's very hard to master your mindset in psychology if you don't get the first steps right. If you're taking way too much risk, it's not premeditated, you're not putting in the effort to obviously do that, it's going to be very hard to control your mind and set some of these things at ease. Now, some of the things we're going to be discussing in psychology requires these previous steps to be tackled, right? You can't have peace of mind if you're risking your whole account. You can't have peace of mind if you're not putting in the time analyzing because you're guessing. And so a lot of these things are prerequisites to making sure we can tackle some of these other things moving forward. Now, in an example, right, let's just talk about the following case study, right? Let's say we've got $1,000 account. We identify a long-term sell position on Euro USD has come to an end and we've seen a reversal. So subsequently, the price action has shown us that we could see a reversal and we start looking for a buy position. So we enter buy position at 1.05500 with a lot size of 0.03. We place our stop loss 80 pips below at 1.0470. Now that's as per our risk management, and so 0.03 times the amount of pips that we're risking here means that we're risking about $24 of our $1,000 account, which is 2.4% risk. So we're in risk, but remember, we've got $1,000 accounts, right? You want to enter these massive sizes because you've got the money, you've got the capital, but risk management says otherwise. So let's have a look at this. So if we have a look at the following chart, right, we could have held this one position, right, for over 200 days. You guys will remember this little bit of a chart that we've been working on. We started off our support and resistance exercise with this chart, and you can see that once that downwards trend had come to an end, we consolidated, and then this new bull market started to form, and that's where we cut the chart off. Now, if we entered into that bull market, that would have allowed us 200 days, right, of consistent trading, meaning we didn't have to open, close, jump in, jump out of a particular trade. We would have been able to hold that particular position for over 200 days. So yes, we risked 2.4% of our accounts, but we yielded 1,400 pips in profit, which equals about $400. So on that one particular trade, we made 40% of an account ROI, return on investment. Guys, 40% is way more than any bank or any legitimate investment will ever give you, and that was just done through investing, right? Investing in the markets, having the patience and the precision to obviously analyze, predetermine your risk, and execute. So a lot of the times when we talk about risk management, people break the rule because they want to enter bigger trades. You need to change that way of thinking, right? Instead of entering bigger trades, we need to enter longer trades that can yield us something that is worthwhile. So we risked 80 odd pips, right, to potentially yield 1,400, right? That is a massive risk reward ratio, but this is where we need to start to shift our thinking. This is where, as traders, you need to start to look at this long-term growth. And again, you could have multiple trades like these, and this is what we look for when we talk about investing. We're not talking about entering a trade today, exiting, entering another one, exiting. We're looking about taking trades and holding them long term. And throughout that process, you're shifting up your stop loss. You're securing profit. And this is where we will migrate. And this is where I teach in the Master Series about the exponential profit multiplier strategy, where you're essentially taking banked profit, using that profit to open up new trades. So you're no longer using your equity or your balance to open up trades, but using a banked secured profit to now open up new trades. So utilizing the market's money to make money. But this can only be possible when you start to deploy these investment mindsets, to take out some of these longer term trade setups, and that is eventually where I would want to see every single one of you. Now, does anybody recognize the pattern? This is the pattern that we originally saw. Now, this is what it ended up doing after that pattern was identified. Let's have a look here, right? That was just one small piece of the pattern, and this continued to rally, like I said, for the next 200 days is where this essentially broke out from. Now, there was clear indications that this breakout was going to happen, ample chance, multiple days to gain entry. It didn't just take a day and it was gone. It was something that hovered around its entry point for multiple days. And even though it took off, it presented multiple opportunities to re-enter, right? This is what we call pullback trading or pullback trading strategy. And I don't like utilizing the word strategy in some of these smaller techniques because it isn't as much a strategy as rather a technique of how to just get into a particular trade. Again, I feel strategy is so much more than that. Everything you do leading up to taking the trade, to ultimately closing that encompasses a strategy, where this is more about technique in terms of how to enter a particular market. So when we talk about an investment mindset, this is something that I want people to understand, is that this is the evolution, this is where things are going to. We trade Forex not for any other reason. Yes, there's great money involved, and when you can get good and profitable and consistent, you can live an amazing life. But it's with the same thing, the one thing that's more valuable than money, far more valuable than money, is time. And so what trading smartly allows you to do is have more time. If you have 2 or 3 investment positions, long-term trades that are running in your particular trend or direction, this would mean you don't have to trade daily. This would mean you could check up on your trades every week, monitor some of your positions, modify some of your positions, and ultimately sit back and obviously live a good life. But that does mean you do need more capital. You can't just have $1,000 account and expect to only make $400 in a year. You wouldn't eat. You would have literally just over $1 a day for every day in the year. So again, that is the dream and that is the goal, but this is where we want to migrate to. This is where you want to build up a track record and history of managing money. So that's just something I want to talk about really quickly, is that it's super important that we understand, yes, buying and selling, scalping, or even day trading is essential, right, to build up your trading knowledge, to build up your experience. And it's a really great way of just being involved with the markets and getting to know and understand the markets. But the ultimate goal here is to start to spot positions that you can take and be part of long term. Take the trend, and when we see these big reversals, be a part of that reversal. Don't be afraid of missing out or any of those particular things, which is what we're going to be dealing with coming up next, because we can see this particular trade, Euro USD, was an absolute monster. It just ran and ran and ran. A whole trading year, this guy just ran in a single direction, no reversal, no fault of any kind. So I'm going to be showing you techniques that will allow you to trade on smaller time frames. They're going to allow you to scalp and obviously have a bit of fun within the day, intraday trading, scalping, day trading. But ultimately, I need everybody to understand that this is not the ultimate goal. The ultimate goal is to be involved in an investment mindset where you can start to take trades long term and reduce your risk, but ultimately increase your reward over the exact same period. Okay. Now, we want to deal with a couple things, and I'm sure after this we're going to address a couple things. They may be sore points, they may be this, they may be that, but ultimately these are going to be items that we're really going to help blow and break away some of the misconceptions about trading and some of the blocks that you may have in terms of your own trading journey. All right, now we're not designed as humans to deal with some of the emotional stress that the markets give, because the markets are unemotional. The markets don't care how you're feeling. The markets don't care if you're having a bad day. You can't call up the markets and be like, yeah, I really wanted to close that position, but you see this happen. Is there any chance you can give my money back? It's never going to happen, right? So it's very strange to us to deal with something that's completely no emotions. The markets do not care nothing. It's numbers and numbers only. So we must understand it's inhuman to be able to relate to the market. So we need to find a way, a coping mechanism of being able to deal with that. Now, because the market is a number game, we need to treat it like a number game. We need to understand what are the ratios, what are the odds, and what ways can we cope with that and put some of these fears that I'm going to address here to rest. Okay. We could be given the best strategy in the world on a silver platter, delivered to our front door, placed in our laps, hands on the keyboard and say go. And even with all of that involved, without mastering your mind and psychology, you would ultimately never come out on the winning side, right? Because again, like I said, majority of trades are won or lost before the trade even happens, depending on the space that you're in and the preparation that you put in before the trade even happens. Now, mastering your mind and psychology will also motivate you. When you understand and break down some of these walls, it'll also motivate you to put the time and the effort in, knowing that the markets are not designed to be against you. Nobody's out to get you, but ultimately it's about what you put in, and letting go of some of these fears is really going to help you dig deep and obviously allow you to really put in as much effort as you physically can. So let's talk about these couple things. So these are by far the 5 biggest things that I find being wrong with traders, or what traders face in terms of these actual roadblocks. So the first one is obviously a big one, and a lot of people fear that. That's why I find a lot of people, when it comes to hitting that buy, hitting that sell button, they sit there in a state of panic. They sit there in that state of I don't know, because they have a fear of being wrong, right? And this is what I need to tell you right now. And you're going to find this controversial. You may find this however which way you choose, but this is reality. Markets are not about being right or wrong. What did he just say? I said that markets are not about being right or wrong. Profitability is not about being right or wrong. You can find a trader who's a 50-50 trader, and he wins half his trades, lose half of his trades, and your mind would say, okay, well, he's not making any money. Well, that's not true, because if a trader has a risk reward ratio of 1 to 3, meaning that every time he loses a trade, let's use $100 as an example. If he set a set risk reward, so 1 to 3 is all he takes minimum, and when he loses $2. But when he wins, he's winning $6. If he loses 5 trades out of 10 and wins 5 trades out of 10, then he's lost a total of $10, right? But the trades he's won out of 6, he's made $30. So he's net positive up $20. Okay, so when we talk about being right or wrong, making a decision within the markets whether to buy or to sell becomes irrelevant, right? The position of that order, yes. Stop loss, yes. All these other things, they are important, but you could literally do an example right now with me. Okay, take a coin, any coin, right? A coin has a face and it heads or it has a tail. You could write down on a chart different currency pairs. On a demo account, I want you to try this on a demo account. Okay, write down different currency pairs on a demo account. Euro USD, USD JPY, USD ZAR, USD CAD, 10 different currencies. I want you to take a coin, and on USD ZAR, I want you to flip. If it's a heads, you must buy, and if it's a tails, you must sell. And I want you to flip a coin for each one of these currency pairs, right? Buy, sell, buy, sell, buy, sell. Then on the demo account, I want you to set up that when you're buying, right, your stop loss needs to be 1/3 of your reward. So you got to look for a proper stop loss, right? This will be a great exercise for you also to just get some experience on your stop lossing. And look for the second support. If you're buying, right, look for the second support, set your stop loss there, whatever that value is, have 3 times, right, a 1 to 3 reward. So if your stop loss is 30 pips, have a 90 pip TP, right? Let's say USD JPY, you hit a tails, I want you to create a sell there. Look for the second resistance level, create your stop loss there. If that's 45 pips, then I want you to have a TP of 135 pips, right? 3 times whatever your stop loss is. And I want you to go through this process for all 10. I want you to set up all those trades. Now, in terms of the odds, right, if markets can only go up and markets can only go down, they move to the side, yes, but ultimately a market can only buy and it can only sell, right? You can only be wrong half the time and right half the time if you flip a coin, right? On absolute maximum, you can be right 6 times, wrong 4 times, or wrong 6 times, wrong 4 times. And what you'll find is that even by flipping a coin, but having a risk reward ratio, stop loss and a take profit in a 1 to 3 ratio, you will still end up with a net positive after flipping a coin on the markets. And you can go ahead and try this on a demo and let me know how you find it. Now, I've done this in live sessions, I've done this in classes around the world, and people's minds are blown. So what am I trying to say? Forex and trading is not about being right or wrong about the direction. If you speak to major Wall Street bankers and traders, they'll tell you that in a lot of the times, it doesn't even matter if they bought or sold, it's how they managed that trade. So if they sold and they were in a loss, did they pre-calculate that loss? Are they willing to hold that loss until the point where it balanced out and became a profit? Or how it is that they manage. So, and there's a lot of controversial things out there that actually support that. It doesn't matter which way you trade, it's the important part is how you trade, right? Putting in all these features, risk reward, so on and so forth. So when it comes to the fear of being wrong, you cannot worry about that, right? You cannot worry about, am I placing a trade in the right direction? Is this going to go in my favor? You cannot worry about that. Now, if you're placing a proper strategy behind your risk reward, behind your risk management, guys, you are set to win. A fear of being wrong is a derivative of losing money. It's live money. I don't want to lose my account. I want to lose opportunities. I don't want to lose all these other things. And we're gonna talk about some of these as well when we move forward. It's a derivative of that. So when you can get rid of being wrong or the fear of being wrong, I as a trader no longer even worry. When I go live and people are with me and I analyze a trade, I take the trade live, I log off. In most cases, I'm right. And in some cases, I'm wrong. And people ask me, but Dane, how do you do that online? How do you go live in front of the world on a live account and take these trades? The reality is I'm not scared of being wrong. I'm scared of losing money, but I null and void that by making sure whatever I'm going to lose, I've already ticked off. I'm scared of losing 2-3%, but I know it's 2 or 3% and I'm okay with that and I've written that off. And that allows you to proceed past that barrier of the fear of being wrong. Now, the next one, which is tied to the fear of being wrong, is the fear of losing, right? And it's almost the same thing, but it can have some differences, right? So many people have this fear of losing, fear of losing money, and it's valid, right? Nobody wants to lose their hard-earned money, right? Especially in this world, all the craziness that's busy going on right now. Nobody just wants to lose money or give this money away to the markets. But again, if you have a risk management protocol and you're making sure when you lose small and you win big, I'm telling you, you can see some amazing results. If we take the same exercise, right, and we say, okay, here's a trader who is only right 20% of the time, 20% of the time, but he's wrong 80% of the time, right? But he has a risk reward ratio of 1 to 9, let's say 1 to 10, right? So he's only looking for those big trades that can give him a nice yield, but he's really bad at that, right? He's really bad at choosing the right direction. This is what ends up happening, right? So again, on $1,000, let's say, he's risking 2 or 3%. So let's say $30. So when he's wrong, he loses $30, but when he's right, he makes 300. So he's wrong 8 times, okay? How much is that? $240, right? So when he's wrong, he's lost $240. But the 2 times he's been right, he's made 600, right? So he walks away with still a net positive of $360. So even a bad trader who's losing majority of their trades, provided they have the right strategy, provided they have the right risk reward and risk management profile, even with losing 8 trades out of 10 trades, still walks away with a net positive balance, right? So it comes down to the math. Remember, the market's unemotional. They don't care. They don't care about what you're going through. They don't care how bad your week was. They don't care if you sat in traffic or the baby's crying or what. They don't care. It's a numbers game. And when you start to break down the numbers, you start to understand that there's nothing to be scared of. We need to treat the markets the same way they treat us, and it is just a numbers game. If you make a bad trade, if you lose, or whatever the case may be, you've got to get back up on that horse and you've got to get on that saddle and you've got to ride it out. You've got to get to the next trade. Now, there was a lot of studies done about the different sort of winning streaks that people can have, right? So on average, if you look at 100 trades, right, and this is a 60-40 trader, a trader who wins 60% of their trades and loses 40% of their trades, it is probable and possible for you to have up to 7 winning trades in a row, meaning 7 trades in a row that go your way and you absolutely on top of the world, right? In the same sense, there's also a probability of having 7 losing trades in a row in the same space of time. So over 100 trades, you can have win, loss, win, loss, win, 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 loss, 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 but there's a probability of having 7 wins or 7 losses in terms of a winning streak or losing streak. Now, if I told you, okay, that here's a dark room, right? There's a dark room, there's a door, and I'm telling you that inside there's somebody there that's going to scare you. You don't know where in the room he's going to be, but you got to go in that room, he's going to scare you, and then you're going to come out, and then it's done, it's dusted, right? Would you prefer that he gets it over and done with? So I gave you a choice. He's going to be somewhere at the back of the room, and you got to wait all that time to get scared, or I can have him closer to the door right in front, so you can get in, get scared, get done. Most people, some people wouldn't even go in the room, but if you had no choice, most people would elect to say, let's just get it over and done with. Let him be at the front of the door. I get in, I scared, change my pants, and I walk out. It's done. It's the same thing about winning and losing streaks, right? If you're in a losing streak, push through it, right? Don't just keep making the same mistakes. If you've identified a mistake that you're doing something wrong, don't keep repeating the same mistake, obviously. But get through that, right? Evaluate, look at what you're busy doing. If you've got a set structure, and this is why I said have a set structure, because you can evaluate all these variables have stayed the same, yet I've lost this trade, I've lost this trade, I've lost this trade. If that's true, get through that losing streak and you could potentially move on to your winning streak and get back into normality. So when you look at it from a numbers game, I know how it feels to lose a trade, to lose 2, 3, 4 trades in a row, publicly, live, with the whole world watching. It is soul crushing. And even in retrospect, you say, okay, well, get over it. But I know how it feels. It can really hurt a person. You can feel incompetent, or that you don't know what you're doing, or you can doubt yourself. But honestly, it's a numbers game. It's about getting back on that horse and getting back out there. The second you win your next trade, it's all over. It's all forgotten. It's all done. And you're willing to now obviously press on and move forward. Now, the next fear, which is obviously quite a big one, is the fear of missing out. And this happens a lot in group environments where, someone posts, oh, look what's happening here. Look what's happening there. Guys, this one is easily fixed. There is thousands of opportunities in the markets every single day, right? If something doesn't meet your requirements, or you're late to that market, or you're not prepared to take that particular trade. I see so many people, I'll be in public, or I'll be at a restaurant, or I'll be somewhere and I'll be with a friend, and they'll see me trading, and I've put in a whole bunch of effort to get to this trade, right? I've set up my pending order, I've set up everything. What are you doing? No, I'm selling VIX, let's say, right? They say, oh yeah, me too. Can I jump in? And I'm like, you want to jump into a trade you know nothing about? Like, I'm in this trade for a couple of hours, and they want to jump in because they're scared of missing out. There are thousands of opportunities available for you that will work better for you. So when you see someone else posting in the group, or someone else is showing profit, or someone else is in a trade, I'll always see this question: is it too late? Can I jump in? Is it ready? Can I get involved? Ignore it. Let that trade go and pay attention to the next one, because there is another trade just around the corner. Now, this next one, which is quite a big one that most people don't even realize is actually happening, is what we call justified versus unjustified confidence, right, within the markets. And this has a lot to do with traders specifically who are trading in a group environment. And let's say it's myself and I'm calling out a trade, or I'm looking at an analysis, and maybe you're following along, maybe you're new and you say, yes, also want to take this, I understand why it's being taken, and you take that trade. What I see happen a lot of the times is people would follow in a trade, they would win. They'd follow another trade, they would win. What you need to be mindful of is this is unjustified confidence, right? Meaning you're riding on the coattails of somebody else. You're riding on somebody else's analysis. You're on the top of the world because you've won a trade, but you haven't yet put in the time to get to that point yourself. And this is unjustified confidence, and this can be a really bad thing, because this leads people to go out there and say, I'm a trader, I can do this. And when they start to do this by themselves and they start to analyze and put in the time, they start to hit all these losses and they don't know why, and it ultimately cuts their trading journey short. And how you can curb this is that you've got to put in the time, you've got to put in the effort, you've got to get to the point where you're putting in an analysis, you are looking at the market, you're putting in the time, and ultimately that results in you taking a trade that you win on your own. And guys, there is no better feeling on earth, right, than putting in the time, putting in analysis, and winning a trade that you analyzed. It is out of this world. And that is where you start to develop justified confidence. Now, too much confidence is a bad thing, but too little confidence can lead to obviously some of these other fears of just failing to pull the trigger, not believing in yourself, so on and so forth. So it's important to build confidence, but it's also important to understand in the early days, and when you have a support structure, you may be developing unjustified confidence where the group is lifting you up, or a mentor, whatever the case is, lifting you up, but you do need to start to fly on your own. It doesn't mean leave the group. It doesn't mean start a trading academy, whatever like that. It just means put in the time and effort to get to the point where you are presenting trades with your own analysis, and you're getting to a point of saying, is this right? I'm looking at this. Someone says, wow, that looks great. Take it and ultimately profit from that. And you can start to really build up your confidence, which becomes justified and is totally your own, and you can fully own that, right? The next big problem that I want to deal with, and it's quite a big one, unfortunately, in this modern day and age, is instant gratification, right? We unfortunately have attracted a lot of people towards the Forex and financial markets, and I'm also to blame on this one because I haven't done anything about it in order to stop it. But a lot of people see this market and immediately think, okay, this is easy money, it's quick money, I can just jump in and I'm going to obviously be making a ton of money. And unfortunately, that's not the truth. Obviously, with Instagram and Facebook and all these, instant gratification machines that we have around us, it's very easy to think you can just jump in and make a ton of money. But ultimately, you can. Possible. I've seen it happen. But the point is, you need to understand that easy come, easy go. Anything that comes way too easy can go just as easily, right? When something takes time to build, when it takes time to master an art and a craft, that is cemented. You've put in the sweat, you've put in the effort, and this will be something that'll last with you for the rest of your life. So instant gratification, we want to succeed now. We want to pay bills now. We want to make money now. We want to drive fast cars, nice things, whatever. All of us want that, and it's human. There's nothing wrong with that, right? Of wanting nice things as soon as you can. But I think the big issue with the markets is the markets love seeing people that are hungry for now, because they will chew you up and spit you out, right? This is where it comes, the investment mindset. It's about having the patience, right, to see something, wait for it, and be diligent in order to execute, knowing that all the previous factors were premeditated, worked out, calculated, and that you're in a position to now act with an informed position behind you, right? And these are, from what I see, some of the biggest issues that a lot of traders have. And again, the fear of being wrong and the fear of losing, the fear of missing out, those you can completely wipe out the back of your mind. Again, if provided you have the risk management, provided you have some of these other tools behind you, because yes, if you've got zero stop loss, I'd be worried about being wrong, because that means your account goes to zero. If you've ever heard that sound on MetaTrader that it makes dung dung when nobody wants to hear that, right? So if you don't have these other things, 100%, I'd say be even more fearful of being wrong, be even more fearful of losing, because you have a lot to fear there. Practicing the right things, putting these systems into place will allow you to evolve as a professional within this field. And guys, when you evolve as a professional, don't put things on Facebook, don't put money on Facebook, don't every time you go to the toilet or you even pass a Gucci store, stand outside the window and take a picture, right? We've got to change this culture of how traders are in Southern Africa. If you go overseas and you see how traders who take this professionally act, they don't put their whole life and every trade, every analysis, everything they're seeing online, because it's a profession, it's an art, it's a skill. You don't see a doctor doing an x-ray of somebody and saying, oh yeah, I think you have chest cancer, and then taking a selfie on Instagram with this person's scan and being like, haha, you see, I'm a real doctor, I found cancer. Like, you don't have to prove to the world that you're a trader. Master your art, get down, put in the time, put in the effort, let your results speak for themselves, and the world will know, wow, this is somebody who's trading, this is somebody who's serious about their art and their craft. And respect yourself. That's all it comes down to. But when you've mastered this mindset, you won't need to be all online and doing all these things, because a lot of the people online, I'm telling you, are struggling with these exact things. They posting their wins because you know how many losses they just had before that. The one win they get for that day, they're posting like, yo, check how much I made. But you didn't see that they blew 4 other accounts. The posting online, all these other things, if it's for you, fine, it may be for you. I do live quite a bit online too, but again, respect yourself, respect the process, and ultimately look after your mind, right? Be kind to your mind. You can't be in a position to not deal with these fears, but you've got all these other anxieties happening in your life. And again, trading feeds on these particular shortcomings. So be kind to your mind, get some sleep, get enough time in. And when you spend time with the markets, spend time in a good environment that's soothing and good for you. And we are obviously going to cover that when we jump into the actual strategy, your whole environment, your whole setup, how I do it, my environment, my setup, this studio, my little man cave, my little processes that I use to get to that place of zero, where I'm just calm, I'm peaceful, I've done all the things I need to do, and you won't be struggling as much with some of these psychological barriers. So I'm hoping that this has helped. I'd really love if some of you can obviously partake in that demo experience, flip a coin, take some trades, 1 to 3 minimum risk reward, even higher it if you want to, 1 to 6, 1 to 9, 1 to 10, whatever it may be, and have a look at the outcome. Obviously, if you're trading on an hour, 4 hour or daily, it could take a couple weeks to evolve until you get an outcome, but I can assure you it's worth it. It'll really help to cement that what I'm saying is not just there to make you feel good, but the math is there to back it up. So I trust you have learned a bit from this. I trust you've grown a little bit from this. In the next section, this is going to be one of my favorites. We're going to jump into price action. I'm going to be showing you all these price action symbols, how to deploy them in the market. Within them, there are multiple strategies. So what people sell as all these strategy things, guys, these are basic things: pullbacks, retests, all these different things. These are all just basic execution. I'm going to show you how to do that, as well as some real strategy towards the end. And then my favorite is I'm going to be doing a Fibonacci teaching. That is going to blow your mind. It's one of my favorite things in the world. So obviously sit back, relax, do this exercise. Let me know if any of these particular mindset blocks have applied to you, or anything of these, or any of these that you've faced. And if there's anything else that I haven't mentioned that you have really struggled with in your trading journey, or something that you're already struggling with and you haven't even started trading, let me know down in the comments below. As always, like, subscribe, hit that bell notification, and I'll see you guys in the next one.